We've covered a lot in this series. You know that financial stress stems from a structural issue, not a revenue one. Your margin percentage. Three mistakes businesses make that keep them stuck. You've seen what's possible when structure gets right. In this video, I'm going to show you the complete framework, the one that I use with every client, the one that takes businesses from financial chaos to financial clarity, systematically in a specific order for a specific reason. This is the major margins method. Let's build it. Most business owners try to fix all of their financial issues all at once. They open a spreadsheet, they Google profit margins, they make a budget, they decide to finally get their books together. They pick a CEO salary number all in the same week, but nothing sticks. Financial structure has to be built in order, brick by brick. Each layer depends on the one laid before it. Skip a step and the whole thing wobbles. Here's the order. Okay, first step is CEO pay clarity. As I've said, I will die on this hill that if you have a lifestyle business, you should create your profit plan surrounded by your CEO pay. Everything starts here, not your revenue, not expenses. It starts with you, my friend. So ask yourself, what do you actually need to take home each month? Not what sounds reasonable, not what you're currently taking. What does your lifestyle actually cost? Housing, food, childcare, extracurricular, debt payments, savings goals. What does all of that look like? And then what does your business need to make to support a 50% profit margin? That number is your anchor. And every financial decision that comes after your CEO pay should point back to it. I've coined the term the keep half principle. So, what that means is your business should keep 50% of the revenue that it earns before even considering your CEO's salary. So, with that being in place, if you keep 50% of your revenue after your expenses, you will be more likely to be able to pay yourself your CEO salary, put money over for taxes, pay off debt, and keep cash in reserves. Because if your business is producing income but is not supporting your life, something is misaligned. And stewardship is about alignment between what you earn and what your life actually requires. Layer 2 is the keep half diagnostic. Once you know your CEO pay target, run a diagnostic for your actual numbers. Not what you think your margin is, what it actually is. So revenue minus expenses equals profit. Divide that by your revenue, and then you get your profit margin percentage. Compare it to 50%. Calculate the margin gap, the distance between where you are and where you need to be. The gap is not a judgment in any way. It is just a map. It tells us exactly what your financial structure needs to close. Now, and only now, we will talk about revenue after we've mapped out what your current margin looks like. The question is not how much money I need to make. The question is, how do I design revenue to reach my required monthly number predictably across 12 months, including the slow ones? This means building a promotional calendar, mapping your offers against your revenue requirements, seeing slow seasons before they even happen, and designing your year versus reacting to it. Most business owners have revenue goals. The major margins method creates a revenue architecture. So not only do we map out the revenue for you, this part of the framework, we're actually looking at, okay, what must happen with your sales and marketing activities to help you produce those revenue goals that you have, right? The next layer, which is layer number 4, is your annual cash flow plan, which is the finalization of your profit plan. And this is where everything comes together, right? Your profit plan is by month what your business cash flow is going to look like based off of your revenue goals, your expenses, your CEO pay, how you're putting money away for taxes, and everything else. So it includes your projected revenue month by month, especially with your different launches in place. Your CEO pay is a fixed line item. Every dollar that comes to your business has a job before it even arrives. That's what a profit plan does. And layer 5 is to just once you have this foundation and everything is built out and the blueprints are there, it's time to actually live this profit plan through a financial management system. So a profit plan means nothing if your books don't reflect it. So you need to get on a platform or even delegate this. So then that way you are able to keep up with your numbers every month and you're not behind. A profit plan on paper or even a spreadsheet means nothing if you're not in real time keeping up with your numbers. So if your numbers are behind, if it's inconsistently categorized, if it's even inaccessible, you cannot operate your plan and you're flying blind with a map you can't even read. And this is when we get on a bookkeeping system. You guessed it, bookkeeping system. I've waited all this time to talk about getting on a bookkeeping system because I believe that your first step should be the plan and then the bookkeeping system. So then that way you can maintain the plan. A bookkeeping alignment means that your financial records are clean, they're current, and they're organized in a way that supports your real time decision making, right? Not just tax compliance, but in a strategic way. So I like to say in our company, Lovely Financials Group, my team works on the books and it's categorized in a way so that you can make decisions, not just what you're going to see on a tax return, because oftentimes that's not as helpful. And this is where our service margin books comes into place because not only do we do the books, we also help you create that profit plan and maintain it throughout the year. But what we've created was a system called the Major Margins Method course, which has live cohorts where we go through each week and each part of this framework. So that way you can build a system and keep up with it throughout the year. This is a layer that most people skip, and it's the reason why everything falls apart. Because without a consistent tracking, your plan just becomes theoretical and you can't lead numbers that you can't see. So when all 5 layers of this framework come into place, something shifts. You open your financial dashboard and you know your numbers, not an estimate. You actually know them. You pay yourself the same amount every month, not because it's a good month, but because you plan for it and your structure is already there. Tax season passes by and it's unremarkable and you knew it was coming, you planned for it, and you wrote that check, or you put it in your savings account and it was paid quarterly, no problem. Slow months don't feel as threatening as they used to feel because you saw them on your calendar 3 months ahead and you planned for it. And then you also know exactly what your marketing and sales effort should be to hit those revenue goals, even through slow seasons. You make decisions about hiring, your offers, and about your investments from data, not just hope. Okay. And this is what financial leadership actually looks like. Not a dashboard that you check only when you're in a state of panic, but a structure that you can actually trust. So I've built this framework into a 4-week live program called the Major Margins Method. It's for service based business owners, it's for coaches, it's for women in business, it's for entrepreneurs who are under that $250,000 mark. They are ready to stop guessing and build the structure once correctly. In 4 weeks, you build all of these layers with me in a live cohort with other business owners. By the end, you will have an actual profit plan, a defined CEO salary, a revenue calendar, and a cash flow system built with real numbers in your real life. It is designed for you, one who's making real money and you're ready to keep more of it. The infrastructure layer makes everything else possible. So, this is the end of the series, but only if you let it be. You now know more about financial structure than most business owners do at your revenue level. You know your margin benchmark, you know your mistakes, and you know the framework to improve it. What do you do with it? The business you want to run, the one that pays you consistently, that doesn't give you those knots and bubble guts every time you open your bank account, that can survive a slow month or a crisis, is not different from the one that you already have. It's the same business with better architecture. So go build it. Bye for now.